everyone. Thank you for joining us today. My name is Corey Dayharsh, and I am here with Dave Foster. And our webinar today is the rules and benefits of 1031 exchanges. Just to give you a little bit of background about your presenters today, again, my name is Corey Dayharsh. I am a business development specialist with Advanta IRA. I've been with the company since 2016. Serving in both the back office, helping process accounting transactions, as well as a client account manager, having a roster of clients assigned to me, helping them with their day-to-day needs with their accounts, and then now switching into the education and sales-based role as a business development specialist up in Western North Carolina. All my contact information is right there for you. You could also find me on LinkedIn or on Facebook if you want to search me there. And my guest today is Dave Foster, the 1031 investor. Dave's got over 25 years of experience utilizing the 1031 investment strategy. He's also an active Advanta IRA client who's had an account with us for over 10 years, if I'm not mistaken, and a great resource nationwide for anyone interested in utilizing the 1031 exchange strategy. Dave, thank you so much for joining me and helping bring this awesome education to our audience. I really look forward to your portion of the presentation coming in a little bit later.
Corey, it's awesome to be here. By the way, I had some time when I was backstage to do the math, and I figured out that as of next year, 2023, you guys are going to owe my wife and I that cruise for 20-year clients. That's how long we've been with you, and I've loved every step of the journey.
Well, being an avid sailor yourself, I'm sure that cruise will be nice, a little bit hands off. I'll see what I can't do to get that coordinated for you. That's great.
Awesome.
All right. Well, thanks, Dave, again for joining me. I'll jump back to Dave a little bit later on, and he'll cover his portion of the presentation on the 1031 exchange rules and regulations. But for now, I'm just going to get into a little bit about Advanta IRA. So we are a self-directed IRA administrator that's been in the industry for about 20 years. We've got just over $2 billion in assets under management. All of our clients' funds that are not actively invested are insured up to FDIC limits. And as I mentioned with my previous roles with the company, we pair each client that we have with a dedicated client account manager. So you as an investor and a self-directed account holder have a white glove concierge level person on your team at Advanta. So it's not like those larger wirehouse custodians where you may have to reach out and deal with a different person 20 different times or every single time you contact them. You'll have one point of contact that you get familiar with and that also gets familiar with you, and that makes things easy as the investor on your side of everything for your self-directed account. The other thing besides that concierge level customer service account manager that you receive is a lot of free education. We know that our industry is very niche and not a lot of people understand it or know about it. So we put out free education on an extremely regular basis. I'm talking 2 webinars a week. We've got a weekly podcast. All of our webinars are hosted on a video library via YouTube, and we also have a blog with industry news and information if you're interested in that as well. So feel free to check out any of our educational content. Again, it's always going to be free from Advanta IRA whenever you're looking at anything to learn more about your options and abilities to self-direct. Now, before I get too far into the presentation or hand over to Dave, we do have a brief disclaimer that we do not provide any tax, legal, or financial advice through Advanta IRA. We implore everyone participating in their investment strategies to do so with their own due diligence and consulting their own attorneys, CPAs, tax advisors, financial advisors, whoever your team is, before you engage in any specific investment opportunities or offerings that you hear about. So what is a self-directed IRA? Maybe you just saw the 1031 topic online and wanted to sign into this webinar, or maybe you're just very new or someone just referred you to check us out. But a self-directed IRA is an account where the custodian or administrator does not tell you what you can and cannot invest into. We simply help you follow the IRS's rules and regulations and allow you to invest into any asset class you may want to. There are very limited rules and regulations on what asset classes are or are not allowed, and that's what we are experts in. So if you've got a way that you know how to earn money and make great returns better than the stocks, bonds, and mutual funds on the traditional market, it is a highly likely probability that you can utilize that expertise that you have in retirement account investing. There's also a number of different plans that can be self-directed. Your traditional and Roth IRAs that most people know about, but there's also SEP and simple IRAs and solo 401ks for small business owners, health savings and education savings accounts that cover yourself, your children, and or your entire family, and any former employer plan you have. So if you were a government employee or a employee in the school system and you've left those employers, you can roll that money over into a self-direct plan without any tax consequence or liability. So it's a great way to get started when you've left an employer and you want to take more control of your retirement dollars. Or also, if you're just wanting to get started or roll over your managed IRA to a self-direct strategy, there's no tax consequence. It's a very easy and simple process that usually only takes a few days and will help you through that entire process as well. Now, if you haven't heard about self-direction, that's okay, and that's very common. Only about 4% of the retirement accounts in the US are self-directed. And putting that into perspective, I saw a blog post last year that the total value of retirement accounts across the US in the fourth quarter of last year was $39 trillion. That's trillion with a T, and only 4% of that money are people taking advantage of self-directed strategies. So why do people choose to self-direct or switch over? Well, they hear, like I just said, that it's a new source of capital for their existing investment strategies and goals and expertise. They decide they're tired of the stock market, the fluctuation or lack thereof, and just downturn, specifically looking at this past year, and even the tax benefit of making investments in a tax deferred or tax free account. When you're making a real estate investment with an IRA into any property and you sell that property, it is a tax deferred entity. So there is no capital gains tax upon the sale of that investment property. Now, keep in mind when you're utilizing the 1031 exchange that we'll talk about today, it's not something you would typically do within your retirement account, but a lot of investors find dual purpose in knowing how this works for their other portion of their portfolio and just having a better understanding of these real estate investing strategies. So again, that's why we're bringing Dave on today to speak about 1031 exchanges, not necessarily because it's something you can do within your IRA, but there are ways that they relate, and he will cover that as well. Now, the key takeaway points I would like everyone to gain from today's webinar is that utilizing the 1031 exchange will help you avoid capital gain tax for real estate owned outside of your retirement account. There is a time-sensitive nature to completing a 1031 exchange, and Dave will cover that time-sensitive portion along with the total 6 steps required to complete a 1031 exchange. And again, we've got experts like Dave here to help you. He is going to take over right now with his portion of the presentation, just explaining everything for you about 1031 exchanges and how to properly utilize them. Dave, with that, I think you have mouse control, and I will leave you on your cover slide here.
Mouse control. Man, I either sounds like I'm an astronaut or a pest eradicator. I'm not sure which, but Corey, thanks so much for that great introduction. Yeah,
Actually,
I
Dave,
was actually.
there's one thing I forgot to mention. My apologies. Everyone participating today, we do have you muted, but we will allow you to drop questions in the question box. So please, if you have any questions for Dave, drop those in the question box. I will get them asked over to him so we can answer them throughout the presentation. My apology, Dave, didn't mean to cut you off. I just realized I forgot to bring that portion up. So go ahead and take over. Sorry.
Yeah, no problem at all. Yeah, part of the reason why I was doing that math is it was amazing me at how long we've been using self-directed IRAs ourselves. And the reason for that is I love I love real estate and I hate taxes. And I hate taxes on all front. And any type of IRA or tax preferred, tax deferred kind of retirement account has always appealed to me. But we started way back in 2003 with Advanta, strangely enough, of using our self-directed IRA to purchase real estate. And it's been incredible because all of that tax is being deferred until at some future point in time. And that's pretty significant. But the reason, but it's only a part of what my strategy is. And we'll bounce into the other two in just a moment. But here's the philosophy that has been a part of the foundational principles of the Internal Revenue Service Code. And I know it doesn't feel like it. In many ways, we kind of feel like we're using the code as an excuse to try and get as much money from taxpayers as possible. But in fact, the attitude of folks like Supreme Court Justice Leonard Hand, who was actually part of the original establishment of the IRS code, has always been that we absolutely should all be paying our fair share. But we shouldn't be paying more, one penny more than our fair share. And the idea is using the tax code provisions to accomplish what we want, which includes mitigation as much as possible of our tax. A great, one of my most loved mentors challenged me a while back to rethink how I look at the tax code. And he said, Dave, stop looking at the tax code as a way for the US government to make money. He said, yeah, they get to do that. But look at the tax code as an incentivizer of behavior. Now, if you stop and think about that for a minute, it'll shift your whole paradigm. The tax code is designed to encourage you to do certain behaviors. And if you do, you're rewarded by not having to pay certain taxes. So let's think about self-directed, let's think about IRAs and self-directed IRAs in particular. Just first, what's the government incentivizing? Savings so that you can provide for your retirement and so that you can live without having to avail yourself, hopefully, of any of the entitlement programs and safety net programs that the government allows. But the incentivization is that as long as you're using your self-directed IRA, or in my world, as long as I'm using 1031 exchanges and using the primary residence exemption of 121, I will never pay tax because I'm performing behaviors that the IRS wants. So totally different than tax evasion, where you're trying to get away with something. These are things the government wants to see. So kind of adjust your philosophy to think that way. Here's where I live, and it's in two worlds. The Section 121 primary residence exemption, Section 1031, which is a tax deferred exchange of business or investment real estate. So inside the federal tax code, there's really three different ways that we can minimize and eliminate tax that we have to pay on real estate activity. You've got, first of all, what Corey's already started to talk about, your retirement accounts, self-directed IRAs, where you can own real estate inside them, buy and sell and operate that real estate. And because it is inside your retirement account, you're not paying tax on the profit. That tax is being deferred into your real estate account. The other two are things that I specifically deal with outside your retirement account. And the one that I actually like the most is not my business, but it's the one that I use that so many people still don't know about. And that's the primary residence exemption found in Section 121. If you buy a house, move into it, live in it for 2 years so that when you've sold it, you've lived in it at least 2 out of the 5 years prior to selling it. So you could live in it for 2, sell it. You could live in it for 2, move out of it for 2, and then sell it, as long as you've lived in it for 2 out of the 5 years prior to sale. Then if you are single, you get to take the first $250,000 of profit tax free. Whoa, how much better is that than anything that Corey or I have to offer on the retirement account or 1031? It's tax free. And all you have to do is buy a property and move into it. What an amazing gift from the IRS. What's the incentivized behavior? They want Americans to be owning their homes so they can take advantage of appreciation, the nesting that's developed, and all those kinds of things that go around home ownership. So you can do this once every 2 years. Now, what statistics tell us is that in general, people live in their houses for 5 to 8 years before they sell them. So by itself, if you do nothing other than buy your houses, live in them, sell them, and go to the next one, you're going to have 8 to 10 opportunities in your lifetime to take up to $500,000, because that's what the benefit is for married couples, of profit tax free every time. That's money that can be used for anything you want. So, what a deal. So, right there, we've covered 2 of the 3 legs of the chair, right? You can take money tax free by simply selling your primary residence every so often. You can indefinitely, until you have to start drawing down from your retirement accounts all of the tax that you pay on real estate activity while it's inside your retirement account. And then here's something that's very similar, but like Corey said, it's almost a way to get the same benefit from your IRA as, but on property that's outside your IRA. And that's the 1031 exchange. With the 1031 exchange, when you sell business or investment real estate, not your primary residence, that's tax free. Business or investment real estate, you get to indefinitely, and I use that word indefinitely very deliberately, defer the payment of the tax that is normally due on the sale. You're going to find that it's actually can be to your benefit once you start this to keep doing it as long as you can throughout your entire life. And then there's a big bonus for you at the end of your life that we'll talk about. But first of all, why would they want to do it? Well, this is the exact same motivation of why you would want to start a self-directed IRA and hold real estate in that. Let's take the example of 2 investors. Now, one could be a retirement account or whatever, but we're going to use 2 investors with real estate outside their retirement accounts. So they're going to be looking at the 1031 exchange as an option. They're going to have the same appreciation, the same sales price. They're going to buy exactly as the same, as much as they can, given their proceeds. Everything's identical. The difference is one investor's going to do the 1031 exchange. One investor is going to pay the tax as they go. Now let's see how this example plays out. So they're going to start with a property sale of $300,000. They have a gain in that of $100,000. Now, federal capital gains on that's probably 15%. There's probably a state gain as well. So to make the example consistent, we simply said that the tax that they would pay is going to be about 20%. It's going to be higher in some states. It's going to be lower in some states. But investor A is going to do a 1031 exchange. So look at what happens in the 4th column. Investor A is not going to pay a penny in tax. Now, the tax doesn't go away It's just deferred. So in that far column, you'll see that they now have a deferred tax of $20,000, whereas investor B is just the opposite. They're going to pay tax, so they paid $20,000 on the transaction, but they have zero in deferred tax. I mean, not a bad deal, you think, right? But look at the after-tax investment. And this is what we're going to see change dramatically over time. Because they did not pay tax on the sale, investor A has their full $100,000 available to them. So with 20% down, they can go buy a property worth $500,000. Investor B only has $80,000 because they pay $20,000 in tax. So they're only able to buy with their down payment a $400,000 property. Does that track with everybody as our first sale? Let's fast forward 5 years. And they're now ready to do this again. Same rates of appreciation. The difference in gain is solely because investor A was able to buy a larger piece of property to start. So 5% appreciation on a larger property is going to be more than 5% on a smaller piece of property. Once again, investor A is going to do a 1031 exchange. So now they have $47,000, almost $50,000 in tax that is deferred. They still owe right now. But because they're deferring that, they've got $238,000 to be used to purchase their next property. Investor B doesn't owe any tax, but they only have $168,000 to buy about $850 in new real estate. So we're starting to see a separation, aren't we? What happens after 5 more years when they're now ready to sell that property? Well, this is where we really start to see the model diverge, aren't we? Investor A owes a truckload of tax, but they're able to buy a property that's almost $1 million more than investor B because they're using the deferred tax. Now, here's a key difference between holding real estate in an IRA and holding real estate outside in your 1031. While you're holding that 2.8 million in real estate outside your 1031, you yourself personally are generating all the benefit of ownership, all of the cash flow, all of the tax write-off of depreciation and mortgage write-off, all of the amortization of the loan is going to you immediately and personally, as opposed to it being tied up inside your IRA. So this is why there's a huge model to use both, because inside your IRA, you typically have more cash reserves that you can use to buy real estate. Outside your IRA, though, you get to take tax benefits as current write-offs on your income tax. So it can be a great benefit to go both ways. And the cash flow that's generated when you own real estate outside your IRA goes to you personally. So investor B doesn't owe any tax, but they're making a lot less money per month, aren't they? And here's where I think it just gets stupid crazy. But look at 20 years. They now sell that property. And look what investor A is able to do. Let's just say it's their last transaction. They're able to buy and own $11.8 million of real estate because they've chosen to do the 1031 exchange and defer the $470,000 of tax. Let that tax bill keep hanging over their head. But as long as they own that property, they're never going to pay the tax. And investor B hasn't done badly for themselves, have they? They don't owe any tax, but which would you rather be? The investor that owns almost 12 million in real estate or the investor that owns 4.5 million in real estate? Because even if investor A said, I'm worried about that tax, so I'm going to take everything I can to at least create a savings account to pay it off. when I need to. How many months, if they're making 10% a year on their money, how many months would it take them owning a piece of real estate at 11.8 million? 4, 5, 6 months of income is all it's going to take to satisfy that deferred tax. And at the end of that, they still own 12 million in real estate, throwing off the income. That's a pretty massive motivation to do the 1031 exchange. And this example really illustrates the exact same concept, whether it's within or without your self-directed retirement account. And that is compounding interest. Instead of paying interest to the government, you take advantage of what the government is incentivizing you to do, and you use that deferred tax to purchase real estate for yourself. And whether it's inside or outside your retirement account, as long as you use it, you're not paying the tax. So the income that is generated off of that also becomes part of that growing tax-free. And then you make income off of deferred tax. And then you make income off of deferred tax. And that kind of thing just snowballs till you end up here in a situation very similar to this. So I may sound like I'm excited about this, but it's because for 25 years, this is exactly what I've been doing on all three fronts. Myself personally is using self-directed IRAs to take large chunks of real estate and move them back and forth, keeping it tax deferred in the retirement account. I sell my primary residences frequently and move as often as I can convince my wife, and that money is tax free. And we do 1031 exchanges on our portfolio so that we continue to defer all of our investment real estate. And I started doing this for others in 2000. So that's 23 years because I saw the power that it was going to have for us. So hopefully that is kind of going to give you a little teaser about that. Corey, I'm trying to advance through and it's not doing it. Did something happen?
Sorry, Dave. I moved my mouse to just adjust my question box, and that maybe moved the mouse on your end. You should still have. There you go.
There we
Yep.
go. It came back. Yeah, it came back. Stop moving the mouse. Oh, gosh. So here's going to be the key, though. This is where I want to kind of spend the rest of time, a little bit of time talking about the 6 basic requirements, because like Corey said, they're very different from an IRA and they're very time sensitive. And the IRS is going to give you no margin for error. So these 6 requirements, and then I want to end with a little talk about strategy and how you can use these. So requirement number 1 is that the property must be property that you hold for investment. Now remember, we said primary residences don't count because you're not using them for investment. What it means to hold for investment is also not fix and flipping. If you're a fix and flipper, that's probably a good thing to do inside your IRA because you cannot do a 1031 exchange on it. Your intent must be to hold the property. So holding the property would mean property that you use for your trade. Maybe it's the building that houses your restaurant, or maybe it's rental property or agricultural property that you share crop out, or maybe it's raw land that you're holding for future appreciation, or a vacation rental where you generate some income, but you also use it some yourself. That's a key distinction because if I'm not mistaken, Corey, inside our IRAs, we cannot have any personal benefit, correct?
That is correct. There used to be gray area surrounding the ability to use a IRA owned property up to 2 weeks through a year. That has since been removed from legislation, and you are no longer allowed to have any current benefit or utilization of a retirement owned property. So if you own a rental property on the beach and you wanted to go utilize it for a weekend, technically speaking, that is prohibited in nature, and that could risk your entire retirement account if you are caught doing so.
Right. So the best place if you want to use investment property, some personally, as in short-term rental or vacation rental, is to do that outside your retirement account where you can take advantage of tax deferral still by doing 1031 exchanges. So whatever the real estate is, as long as your intent is to hold it for productive use, and as long as it is real estate itself, then it qualifies for 1031 treatment. Now, there's two timing rules that are critical. When you sell a piece of property, that's going to start your 1031 exchange. You have 45 days only, calendar days, to identify your potential replacement properties. Once day 45 happens, you can no longer change your list. You are stuck with what's on that list. So the 45-day window is pretty critical. Now, what I tell people though is that don't start your due diligence when you sell your property. Start your planning way before that, because it's perfectly fine to go into contract on your new property anytime you want, even before your old property sells. We simply have to close the sale of your old property before you take title to the new property. So many of our clients will exercise the period immediately prior to their sale and get their new property under contract so that they actually close on their new property during the 45-day period. That's perfectly fine. And that mitigates a lot of risk. But if you're unable to do that for whatever reason, you do have 45 calendar days to identify, and then you have another 135 days for a total of 180 to complete the purchase of your new real estate. So 45 days to identify, a total of 180 to purchase. Now, I want to talk about a little caveat to that 180-day rule, that it's actually the lesser of 180 days or the date that your next tax return has to be filed. Now, that's easily solved. If you close your property in December and you're not ready to close your new purchase, maybe it's new construction that's not ready, and you're not going to be ready to close that until May, but your tax return is due in April, all you've got to do is file an extension. Easy enough done. But the reason why I bring that up is to illustrate that there is no penalty for starting and not completing a 1031 exchange. If you choose to not complete it, then your accountant simply doesn't report it. They take the 1099 from your sale, they adjust that with whatever your basis is, you pay the tax. Or if you do complete your exchange, then your accountant files the Form 8824 and that defers all the tax. So either way, but those are the two timing rules. There are never going to be any personal exemptions or exceptions for you. Many times you will get an exception for wildfires in California, Hurricane Ian, as it's under an extension in Florida and South and North Carolina. But the president has to declare an emergency, and then the IRS has to agree with them. So that's easier said than done. So it's nice to hope for an extension, but don't count on it because you're not going to get one just for yourself. Now, 1031 exchanges, just like IRAs, are not do it yourself. You might be able to control it and you direct the process and you're the quarterback, but the IRS requires that to complete a 1031 exchange, you must use the services of a qualified intermediary. These are folks like me. This is what we do. And we have to be unrelated third parties to you, which is why we're such a great partner with Advanta, because we cannot work on your retirement accounts with you. They cannot work on your 1031 exchange. It's got to be two totally separate things and issues. So the qualified intermediary's most important key point is that they have to be involved prior to the closing of your sale. Because if the closing happens and there's not certain documentation on the settlement statement, if you touch the money, doesn't that sound familiar? If you touch the money, then your ability to 1031 exchange is over. So the QI has to be involved prior to the closing of the sale. Now, many people will ask me, how soon, Dave? Well, my world's record is 10 minutes, literally, from the first phone call to having the documents ready and at the title company. But that gave me a lot of the gray hair that you see on the screen there. And what I'd recommend is that when you're just starting to think about selling that piece of property, that's when you want to start exploring your options. Sooner is always better than later. And when we start talking about some of the strategies here in a moment, you'll see how we can really help you to identify how you can use this process to get you to the goals that you're trying to get to. So the fifth requirement is that the taxpayer for the old property also has to be the taxpayer for the new property. Now, again, just kind of coming off the similarities here, if you own property in your IRA, it's really not you that owns that property, is it? It's Advanta IRA. Corey, how does that usually read on the settlement statements when you guys sell
Yeah,
a piece of property?
so Dave, I'll use your name for example. If your retirement account owned a property and you bought it or sold it, the deed of title is going to be in the name of Advanta IRA for the benefit of Dave Foster with your account number reference. So your account specifically is the true holder, but it's held through Advanta IRA as the custodian administrator. The tax ID number is through Advanta IRA's trust tax ID. So nothing should be tied through you, Dave Foster, as an individual, or your social security number so that we avoid any potential tax liability or consequences there.
Exactly. And so when you're doing the 1031 exchange, it doesn't matter who's on title or who goes on that settlement statement for the sale. It's only that that has to match with the purchase. So if you own the property as an individual and you sell it, then you'll need to buy your replacement property as yourself, the individual. If it's any other kind of tax-paying entity, like an LLC, a corporation, a joint venture, a partnership, that same entity is going to need to take title to the new property. So that's important to match up. And then lastly, and this one's probably aside from the timing requirements, the one that creates the most angst. And that is, what is it that I have to purchase? If you want to defer all tax, you want to think about this as a two-part requirement. First of all, you have to use all of the proceeds from the sale in your next purchase. You cannot touch any of the money. Now, you could do a partial exchange, meaning sell a property for 300,000, buy something for 280, and you take 20,000 in cash. You can do that. You'll pay tax on the difference, but it doesn't necessarily have to mess up the rest of your exchange. But if you want to defer all tax, you got to use all the proceeds. Secondly, if you want to defer all tax, you must purchase at least as much as your net sale. Now, again, you can purchase less than you sell. you'll pay tax on the difference, and you'll still shelter whatever other tax was in there. But if you want to defer all tax, use all the proceeds and purchase at least as much as your net sale. Let's say you sold a property for $320,000 and there was $20,000 of closing costs and commissions. Your net sale is $300,000. If there was a $100,000 mortgage, then that is paid off after that, and your net proceeds are $200,000. To defer all tax, you would need to purchase at least $300,000 in real estate using all $200,000 in net proceeds. The rest of the money can be a loan. It can come from yourself personally. You can maybe borrow it if your retirement account is set up correctly to finish the purchase. You can get a loan from Uncle Al. It doesn't matter. But those are the requirements if you want to defer all tax. Purchase at least as much as your net sale. Use all the proceeds in the next sale, in the next purchase or purchases. So those are the 6 requirements.
And Dave, real quick, there
Yeah.
were 2 questions relative to those 6 requirements. I believe the first one was tying through your example you were just providing. This one reads, do you pay tax just on the profit? I believe that maybe if your example there of utilizing a portion of it and then taking a portion out for a lesser utilization for the next property.
Yeah, that's a great question. And it's hard to get your arms around because the IRS thinks about this 2 different ways. They will tell you that you will never pay tax on anything other than profit. So if you don't do a 1031 exchange, you only pay tax on the profit. If you do a full 1031 exchange, you don't pay any tax. But in the case of a partial exchange, let's say you took $20,000 out. Here's where they get funky on you. The IRS will say that $20,000 is profit first. Now, you and I and everybody in the world wants to stand up and yell, no, it's not. $20,000 is my original down payment. It's not profit. And I totally agree. I get it. But when you do a 1031 exchange, the IRS says in exchange for doing the 1031, we're deciding to declare that any money you touch is profit first. So you call it your original capital. The IRS says it's profit. Who's got nuclear weapons? They're going to win the argument. Does that make sense? Did I answer that question?
To me, that makes sense. I'll allow the person that asked that question to clarify or reiterate further. And then I'll take this time as well to just remind the attendees they did say yes. You can drop your questions in the question box as we're going along. There's one other one, Dave, I had for you before we move on to a review of the basics. What is the qualification process for the qualified intermediary, and/or, is it just the IRS that's the governing body there? Can you explain that a little bit further?
Oh my gosh, yeah, this gets into the deep weeds here. There's actually no credentialing that's involved. Now, this is totally different from the crazy amount of SEC and IRS oversight that you guys go through, or even the amount of education that's required to become a realtor. The IRS specifically says that a qualified intermediary is someone who is an unrelated third party. The only thing that disqualifies you potentially from being a qualified intermediary is if you're disqualified. I swear to gosh, that's how it reads in the statute. So thank you, IRS, for that help. And you're only disqualified if you have a business or family relationship with the clients. So Me simply saying that I'm a qualified intermediary means only that I don't have any other relationship with you. It doesn't tell you whether I'm experienced, whether I know what I'm doing, whether I have a clue, or whether I'm handsome and healthy. It only means that I'm an unrelated third party to you. So, right at this point in time, I realize, Corey, everybody's running for the hills saying, oh, I'm so scared. Well, the idea is not to scare you, but simply to let you know that you want to find the QIs you want to interview, but then you want to do due diligence on them. Because being a qualified intermediary for 1031 exchanges means that I don't do anything else for that client. I'm the accountant in our firm. So I'm an accountant who doesn't do taxes. The rest of my firm are attorneys. They're attorneys who don't practice law. All we do is 1031 exchanges because that's all we can do when we're working for those clients. And so that kind of creates this, as my grandpappy used to say, it makes us go 2 miles deep in a 2 foot wide creek. It's a small part of the statute, but we try to know everything there is about it. And it's all we're going to be able to do. So, as part of your due diligence, look for them to protect your money the right way. 99% of the QIs in America will keep their money in a pooled trust account, much like what Advanta IRA does. Now, the difference is, though, there's no IRS or SEC oversight over those accounts like there is for Advanta. Man, the hoops you guys have to jump through are just crazy, Corey. What we choose to do, though, rather than put our clients at risk that way, with by having a non-SEC monitored trust account, is that we set up segregated FDIC insured accounts for every exchange. These accounts are in the name of the client, and they're set up so that money cannot move without the client's signature. So they're protected for Advanta clients through all kinds of layers of SEC and IRS requirements. They're protected outside your IRA by dual signatory FDIC insured accounts where funds can't move without your signature. And I'd say that's question number one. Find out how they're securing your funds. Question number two, how long have they been in business? Get some, talk to people that have used them. Find out what their experience was like. Because you're going to find out right away how much they really know. Right now, everybody on this call has learned about as much about 1031 exchanges as 75% of these CPAs in America because it's such an obscure, deep topic. So don't just let somebody call themselves a QI, ask questions so you can find out what they know. And then thirdly, check your fit. If you just want someone who's going to be processing paper for you, the 1031 exchange at its most basic is just a bunch of paperwork. And really, kind of anybody with a template that they begged, borrowed, bought, or stole from anybody can become a QI. But if you want a QI that's going to be more of a guide for you, and someone who's going to be going to be able to help you strategically, then you want to interview your QIs based on that, their availability. Do I really get to talk to a senior, accountant, attorney, someone that really knows this stuff? Or am I talking to a marketing rep? Am I talking to someone who's available to me? Am I talking to someone that I can pick up the phone and get a hold of without waiting for a bunch of days? So vet your QI, that's all I'm saying. But by and large, it's an incredibly safe industry. But just don't be fooled by thinking that there's anything that qualified intermediary means other than that they're not disqualified and that they're an unrelated third party. Did I beat that dead horse enough?
That was a great and very articulate answer to that question. And I definitely reiterate your sentiment of, specifically based on your answer, doing your due diligence for everyone that listened to that and is interested in 1031 exchanges.
Beautiful. So and if there's more questions, kind of feel free to interrupt as you will. But
There,
reviewing the basics.
before
Yeah,
before
go ahead.
you move on, as we were speaking there, actually about 5 or 6 different ones came in. So if you want to cut through review of the basics and we'll go over these questions afterwards, or if you want me to just keep fielding them now, it's completely your call, Dave.
Let me put these up right now and let's
Okay,
spend a couple minutes answering questions based on this. And then I definitely want to leave 4 or 5 minutes at the end to talk about how to use these strategically.
perfect. Okay. Well, I'm going to jump back into the questions then. The next one that popped up, can I retitle the property after the 1031 closing occurs? Example, old
Absolutely.
property is in husband's name, new property is in husband's name. After closing of new property, can I retitle the property in husband and spouse's name as joint tenants with rights of survivorship? How long
Yeah,
would I need to wait?
you don't have to wait at all. And it's actually interesting because if you and your husband file a joint tax return, you're actually both the same taxpayer anyways, because the taxpayer is the tax return that reports the activity of the property. So you could actually take title to the new property as you and your husband, or as your husband, or even as just you. And that's not changing the taxpayer. But in general, it's perfectly fine to change the taxpayer after a 1031 is complete at any time you want. Depending on the entity that it's in, your accountant may have some suggestions on how to do it, but it doesn't have anything to do with the 1031.
Perfect. Next question here. How long after completing a 1031 exchange must the new property remain an investment property?
Long enough that you can demonstrate that your intent when you bought it was to hold for productive use. Now, if all you do is sell it at any point, you're going to pay the tax. So tax deferral is only as long as you own that property. If you sell the property, if you want to keep the tax deferred, you've got to do another 1031. If what you're talking about doing is converting the property into your primary residence, I tip my hat to you because that's an awesome strategy. There's no statutory holding period. What there is a safe harbor from the IRS in 2 years. They will guarantee it under certain criteria. At 2 years, you can change the use of it. There's also a lot of people that say anything more than a year is fine. And certainly, while you're using it for investment, you can use it some yourself personally within certain limitations. So, does that answer your question? It's kind of a floating scale.
I believe that did answer that question, yes. And it also, the tip of the hat was an interesting sub point to that I kind of just made my own personal note on.
We're going to talk about that in strategies in just a second. Yeah.
Sure. Okay, so we've got 4 questions right now. I'm going to merge 2 of them together because they came from the same individual. Um, so this one is, how do you find your investments for your 1031 exchanges personally or through syndications, etc.? And then that same person asked, do you find that 1031 properties tend to have lower or same IRRs?
That's a great question. At its basic level, there is no difference between a 1031 property and just a piece of real estate. 1031 is how you treat it so you don't have to pay tax on the profit. So, how do I find properties to invest in? I go find good real estate investments. And then when I'm ready to sell them, I'll do a 1031 exchange. That makes sense? The 1031 exchange is like the icing on the cake. And what I'm doing is I'm locating good properties. Now, when might be a good time to do a 1031? And this falls into strategy in a moment as well. Maybe when your IRR starts to drop, the debt that you've got on it is too low, so the amortization is low. The NOI could be improved. or whatever it is, there's got to be a why that makes you want to sell. And when there is, use the 1031 exchange to go buy your new property. And what are you going to buy? A property that solves the why. So it's just regular real estate investment, like always. The part about the syndication is huge because you want to know that 99% of the syndications out there right now, you're not buying real estate. You're buying a membership interest in an entity that owns real estate. And that doesn't qualify for a 1031 exchange. But what's huge about that, and Corey, what a segue to what you do, because I'm buying real estate itself outside my retirement account because I get the tax benefits, but I can buy syndications inside my IRA because I'm not worried about tax incentives and because I can buy a membership interest, can't I?
Yes, any passive income strategy, and we do see a lot of real estate investors utilizing syndication investments to place their money, just for the simple capacity that limited partnership is really mailbox money, as long as you vet it out and done your due diligence on the general partners and the operators of that syndication.
Absolutely. What else we got?
There was one quick question I answered myself. I'll just say it out loud so the rest of the audience can be privy. In an IRA, who pays the ancillary escrow fees like appraisals, HOA, etc.? In an IRA, the answer is always the IRA. Whatever percentage of ownership the IRA holds in the property, it is subject to pay all of the expenses up to that ownership percentage and or receive all the income relative to that ownership percentage. So that in itself is a quick answer there. And the final question, as of right now for you, Dave, can you talk more about like-kind options, specifically if someone does not want to be a landlord anymore?
So like kind options, um, any type, anything that can be counted as real estate. So this is one of the things that will happen as you grow older. You start to want to go from active management to passive management. And so you can do that by investing in real estate early on where you manage it, to investment where you hire property managers, to real estate that might be in a multifamily where you can have in-house management, or real estate that might be in a resort, as long as it's real estate where it's centrally managed. Or it could be real estate that's in the form of a Delaware statutory trust, which is a specific entity like a syndication, but it's been specifically blessed by the IRS to qualify for a 1031 exchange. And I don't want to go any more down that rabbit hole because it'll take us too long. But those are the kind of things. But the 1031 has got to be real estate. Now, here's why and how you can make it work. So the first thing you can do is consolidate. Take several pieces of property, consolidate them using several 1031 exchanges into one larger one. Sell $500,000 rentals, use the proceeds to go buy one $500,000 property. The number of properties doesn't matter, only the amount. So again, can you see some ways you could shave off management by doing that? What about going the opposite direction? Diversifying. Sell a property that's highly appreciated for $200,000 and go buy $200,000 properties. Again, the number of properties doesn't matter, but in this case, we're growing our portfolio. So you can grow larger, you can grow smaller. You're looking to minimize tax all the way. Maybe that's moving from a state that's highly taxed on your income to a state that's lowly taxed, or taking advantage of the market inefficiencies, selling in, say, California when appreciation peaks, and buying in Omaha where cash flow is king. You can buy anywhere in the United States and you can buy any type of real estate that you want. And this would include going from, say, rentals to triple net triple net industrial or commercial properties where the renter is managing the property. What a great way to make the move into passive management and getting out of active real estate ownership. All those will work. Planning for retirement. Ahead of your retirement, where are you going to go? You want to come down to Sarasota, Florida? Well, then start to use 1031 exchanges to position your real estate there. And when you sell your primary residence in Cincinnati, Ohio, remember that money's tax free. Come down to Sarasota. Where are you going to move? How about into one of those formal rental properties? Corey just took some notes on that because you can convert a property into your primary residence without creating a taxable event. And that means that all of the profit from the sale of your primary residence is tax free. The 30 seconds of Dave's story. I went from Denver, Colorado to Stamford, Connecticut to Cape Coral, Florida, using a combination of all three of these, never paid a penny in capital gains tax, and managed to use tax-free dollars to purchase a sailboat and move my family onto it and live for 10 years while we paid for it with the income from the real estate portfolio and grew our retirements. So we were continuing to invest our retirement as we went. It's called the 4 Ds of 1031 investing. Defer, defer, defer. And then finally, the end game, it's not defer, Corey, it's die. Because when you die, your heirs get a step up in basis, and all of that deferred tax disappears for your heirs. What an incredible way to generate tax deferred income for yourself throughout your life and then give tax free gifts to your heirs after you pass away. I'm a huge believer, obviously, and there's how you can get a hold of us.
All right, Dave. Well, if that wasn't a little Easter egg callback to something you said on your first or second slide about the benefit later on in life of doing the 1031 strategy, is surely that benefit there to your heirs that you just slipped in there at the very end. So I really love how you did that. Among the rest of the entire presentation has been wonderful. As I mentioned a few times and you made note of, I took multiple notes and I will be sure to listen back to the recording, which will be posted in about 24 hours. And everyone that has signed on or even registered for this webinar will receive a recording. Please feel free to reach out to myself or Dave if you have any questions. Myself, obviously, for the retirement account investing side, and Dave directly for any 1031 questions or interest or information. Thank you all for your time participating today. Dave, thank you for your time and your education and knowledge. Hope you have a great rest of your day. Any final words for you, Dave, as we leave our audience?
Man, just everybody go have an awesome day. Go be good.
All right. Well, thank you all. We will be back next time with our next webinar. And again, reach out to Dave or I if we can help you with anything.